Is the correction over? Was that it? Our stock's now poised to buck the historical trend and get back to gains as we turn the calendar to September. Let's ask Cameron Dawson, the Chief Investment Officer for NewEdge Wealth, here with me at Post 9. Welcome back. So how about that?
Yeah.
Are we finding our momentum again?
Well, I think that it is a healthy sign to see this broad-based participation in the upside of the market. It is remaining to be seen if we can get through September unscathed. Our base case is that this will be in that short and shallow category, meaning it wasn't the start of something more nefarious as we looked at August.
You mean the correction?
The past correction that we had. We weren't expecting it to look like 2022, for example, the beginning of something, because it wasn't ever about growth. It was about interest rates. It was about valuations and positioning. So that would say that seasonality likely means during this sideways chop. Does it mean we return to that up into the right market of May, June, and July? Maybe not, but that's very different than expecting a big, deep drawdown.
I think you were looking for a little bit more of a drawdown than we probably got, though, from our last conversations. You know, once we started to look a little edgy in the market, it appeared that maybe, momentum was lost. Rates were going up, that we may have a little bit of a problem, even if we, to your point, still weren't predicting a big decline.
Yeah, and that we never really saw breadth wash out either, meaning that we saw some movement in the participation of things like number of names under the 50-day moving average, but they never got to the place of being fully washed out, which would suggest that, yes, we have seen markets bounce back. We've not made a new high. We've not surpassed that 4,600 level. It will be interesting to see how we interplay with that level. If we can get past it with momentum, then it's a very different story than if we bump up against it, roll over. Maybe you are still stuck in a little bit of a churn digestion.
Why have we hung in there? What's been the determining factor as to why this correction that we started a month thinking a lot about, end the month thinking, well, okay, maybe that was it?
Earnings, 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 meaning that earnings expectations and revisions have actually gone higher over the last 3 weeks, not lower. You started the month at $218 a share for 2023. Now we're at $222 a share. You've seen a similar move higher in 2024 earnings. A lot of that is because economic data is coming in better than expected. Look at economic surprises, really strong over the last 3 months. That has started to roll over more today with the weaker JOLTS data. But I think as long as earnings hold up and you see this continued revision cycle upward, the market can remain supported. The
risk is that once you get into September, you get downward revisions on earnings. That's what I hear more people talking about. Now, maybe it doesn't come to fruition. To your point, that's going to be key. How about yields?
Well, yields did back off today, and I think that does explain the leadership that we had, tech and growth doing better than the rest of the market. I think that the trend in yields for at least the 10-year is still higher. That is one of the few areas of the market that has a very resolute uptrend at this point, which means that I don't know how much I would count on a drop in yields in the very near term to be the ultimate boost and driver for this market. The thing that's been so interesting about 23 is high yields have not mattered for valuations or for the market. So how much will they matter if they start moving in the other direction?
I don't know. Why would they start moving in the other direction higher? And what do you make of the move lower today? Right? What were we just at, like 433, 431? Here we are, 412. Yeah. A couple days.
It does speak to how positioning is very one-sided within the bond market, meaning we have these very short futures positionings. Of course, some of that can be offset by positioning in other places. But obviously what we have is an environment where yields are very sensitive to incoming data. Today was immaculate in the jobs data. This idea that you could see job openings continue to come down and not have it yet show up in real job activity, not initial jobless claims popping higher. That will remain to be seen on Friday. We think the most important thing to watch is average hourly earnings. If that remains elevated, that will likely reverse these bets where the bond market started pricing in less interest rate hikes by the Fed, meaning you'll have that upward pressure again, and maybe this yield move continues to drift higher.
I mean, we need the data to be good. We just can't have it be too good, in a sense. And that's what the JOLTS number was today. It was a little light. It still showed, you got a good labor market.